Another flash crash coming. Some market pros think so. This is an article from CNBC that came out today that is telling us that another flash crash could be coming. Another one. And I don't call it the flash crash. I will put the headline on the topic for that because I think more people would search for a flash crash than conspiracy lows. And well, that's the name I have given it, is conspiracy lows, because what happened on that day, on May the 6th, to me still remains a conspiracy. And we're now going to move to this article, and I'm going to read well over 3/4 of what the article has. Not everything in this article that I have written here is linked to the article. The less important stuff I did not put on here, but it is available in the more information box. Let's start off with this article. The May 6th flash crash may be history, but its after effects and threat to the stock market continue to loom large after two recent mini crashes in individual stocks. Regulators have characterized the initial flash crash, which saw the Dow lose nearly 1,000 points in a matter of minutes, as a one-off occurrence possibly attributable to a fat figure trade or some other market anomaly. And what I'm going to do with this article is read some of the paragraphs and then comment on the particular paragraphs, and this will be one I will comment on. They first state that it was a 1,000 point loss on the Dow in a matter of minutes, and this is false, unless you're talking about a few hundred minutes, because the market was selling off all day. It was down 400 or 500 points before the flash crash came into existence. And they are still stating that it is possibly a possible attributable to a fat finger error, which was using the B instead of M, trading billion instead of million. Citigroup later on denied this information, that it was a fat finger error, which of course made absolutely no sense. And well, they say it could be some other market anomaly, showing they don't even know. And if you're investing in stocks and they don't even know this stuff, good luck. Good luck. But a growing chorus of traders and legislators believe the flash crash is symptomatic of a larger problem with high-frequency trading and a market that lacks visibility and is susceptible to similar events in the future. Once again, like I'm saying, because they don't know what's going on, they can't understand this high-frequency trading I guess, and well, if you're investing in stocks, just keep that in mind. We have a global economy and a global trading system, but we don't have a global framework to deal with it yet. And that's exactly what I'm stating. They say they can't deal with it. So either this stuff is set up behind the scenes, the old conspiracy, and then they're going to do what they want to do, or they don't know. Either way, it doesn't look good in my opinion. And then Doug Roberts, who is a chief strategist at a investment company, says until you do, you're going to be prone to this. With the average investor, they're going to want to be a little bit more conservative, telling us we're prone to this type of stuff. It's part of the business. Just deal with it, I guess. And the average investor that they talk about. What is an average investor? And how many of these average investors are actually profiting? Because the majority of traders are actually losing. Even if you are very good at trading, that doesn't even mean you're guaranteed or you most likely will have some profits. The reason for this is the vigorish or the VIG or the fees, like the trading fees that you have to pay. You have to get past that issue. So you can't be average. You got to be better than average to be profiting. And they're saying to be a little more conservative. Well, if you don't know what you're doing, you're a long-term loser, my advice is either learn how to become a winner within the equity market or don't play at all. The problem could be even more serious when it comes to investor confidence. While market volume always thins out in the summer, some think the flash crash also is playing a role and could be a long-term deterrent to participation if regulators don't come up with preventive measures soon. People are voting with their feet, says Senator Ted Kaufman from Delaware, who has been pressing the Securities and Exchange Commission, the SEC, and Congress to address the underlying causes that led to the flash crash. Why would they not be concerned? We are playing with dynamite here. The non-transparency that stems from high-frequency trades, which can happen in milliseconds, makes tracking the trades virtually impossible. Some estimates have high-frequency trading accounting for about 70% of all market activity. And this is a very interesting paragraph. So it tells us the non-transparency that stems from this type of high-frequency trading, which is computers automatically seeing the information that is given to us within the, or not to us, to them, from the bid offers, the ask offers, market orders, stop losses. They can see what people want to do and are able to make trades based on that. And they state that it's virtually impossible to track it. So if they're lying to us and for whatever reason, eek, that's not a good thing. And if they're telling the truth and it's not possible for them to track it, eek, that's not a good thing. After all, 3/5 of the trading it states is from this sort of market trading. Very, very scary, I think, in my opinion. Before you can actually get involved with the market structure, you have to have some idea of what is happening inside the black box. A bunch of people sitting in a room staring at the black box and saying, what are we going to do about it? Doesn't help. Kaufman says the high-frequency trading industry has been very successful in slowing down any real investigation into what's happening. And this, again, is a very, very interesting paragraph. And I say this not only because of they have stopped an investigation to what happens. After all, I'm calling this the conspiracy lows. But what has stopped the investigation from happening within ending the Fed? They say it would be bad for the economy if we did an investigation on the Federal Reserve. And what has stopped the 9/11 attacks from having a real investigation? I really don't know. Defenders of high-frequency trading say it pumps liquidity into the markets and makes fair trading possible. But perhaps the most stunning characteristic of the flash crash was that liquidity actually evaporated from the market, sending shares of some big-name companies momentarily to a penny when they couldn't find a bid. Wow. I would love to get in on that penny stock, I guess. And once again, as I've said within this video, if they don't know what they're doing, you never know what you could possibly have happen towards yourself. And finally, with this article, exchange-traded funds, many of which pop onto the market with little notice and trade at anemic volume levels, were particularly susceptible to the flash crash, accounting for about 70% of canceled trades in the aftermath. And this chart that I have on the screen, this is the 1 second time frame from 2:43 and 30 seconds on the 6th of May. This is Eastern Time or New York time, up to 2:52. So we've seen a move from about 11:07 down to about 10:67. That's about 40 points, or about 4%. This is in about a couple of minutes, if that, going to the downside. And this moving average is the 50 period or the 50-second moving average. Like, look at these big moves going from 1095 down to 1085. That's about 1% in a few seconds, or over 100 points on the Dow in a few seconds. And this is extremely volatile. And normally, if you look at a tick-by-tick S&P 500 chart, it's not going to look like this. For what I did today was I did a chart of the S&P 500. This is yet another unofficial chart from 306 to 314 Eastern Time. And the movement from top to bottom was only, heck, about, I got it written down here, $3.50. $3.50. There were moves that happened in just a little while, and I wrote just a little bit to conclude this. This chart shows 8 minutes of trading on June the 21st, 2010. This fell from 116, or we'll say 16.75 to 13 a quarter. This was a total of $3.50. On the 6th of May, there were seconds where the chart gained or lost this much. In fact, there were retracements that was over $5 for both directions in 1 second. This is like the Dow moving 50 points in 1 second. In my opinion, investors should realize that if this type of market actions happen at the potential top of the bull market, then the movements that can happen later on often makes the original move look like peanuts. For when we look at the original chart, we can see these big 1 minute moves here. Look at this move here, from 1075 down to 1070 in a matter of a minute. This move here from 1097, this is about 2 minutes, and then back up about 5.5 in a second. If I said minute, I meant to say seconds, because I'm used to not looking at 1 minute charts. Nonetheless, when you have market volatility like this, they're not telling us that it is a form of gambling. I think they should, but I think it's because they don't want to scare people out of investing or putting money into this type of market. At least that's how I have portrayed this situation to be. Thank you everybody for watching, and have yourself a magnificent day, everyone. Bye-bye.